Welcome back to another Kingscrowd Podcast. I'm Brian Belley, Vice President of Product at Kingscrowd. Each week on this podcast, we dive into the world of online private market investing, bring you the latest deals, trends, and insights to help you make smarter investment and capital raising decisions. So whether you're a startup investor, a founder, or another industry professional, if you care about the future of the private markets, this is the right place. Let's get into it. This week, there are two segments of today's show that we want to discuss and dig into. In the first segment, I'm going to be joined by our Kingscrowd Senior Investment Associates, Léa and Teddy, where we are going to dive into revenue multiples and what those have looked like basically since over the last 12 months, so from 2024 to 2025. We'll break that down by industry and then give some of the insights and look at some of the outliers as well from that data. In the second segment, we will be talking about a deal that has recently gone out of business, and we want to do a bit of a post-mortem analysis. So we're going to break down PvP. It's a kind of Web3 gaming company that raised a few rounds of capital online, recently went out of business. We're going to take a look at that Kingscrowd raise page and see, were there any kind of hints of, the potential future there, or just talk about some general takeaways and insights. All right, well, welcome to Léa and Teddy. Welcome back to the show. Let me pull up my screen and let's talk about today's chart of the week. So this week, we wanted to take a look at revenue multiples by industry. This is a chart we've run a few times over the past few years, and we want to refresh it. So this data is fresh from April 2024 to May 2025. Now, each of these lines represents a different industry. So you can see apparel and fashion, consumer products, goods and services, fitness and wellness, etc. And then each of the points on this chart represents a different company with a revenue multiple. So what we did is we took all of the equity raises that have raised capital online basically over the past 12 months. We broke down by industry, and we also sort it by stage. So you can see here, pluses are growth stage companies, and the circles are early stage companies. And each dot on this axis represents where its revenue multiple was. So you can see this x-axis goes from a revenue multiple of 0 all the way up to 100. And now it is just good to be aware that also some of these industries actually went far beyond 100 for some of the outlier data points. For example, Boxable, I think, had a revenue multiple of 10,000 plus. Some other ones had in the energy, power, natural resources had revenue multiples in the 400s. So those data points are off this chart, but we're kind of just looking at the subset of data here that goes from 0 to 100. I will kick things off with a quick discussion. I think one of my first takeaways taking a look at this is that there's definitely a range, and it definitely depends on the industry in terms of the range of valuation revenue multiples that we are taking a look at. So first, we should take a step back. What is a revenue multiple? Basically, it is taking a company, it normalizes their annual revenues by what the valuation is that's being offered. So let's say we're a company and we're bringing in $1 million. If we are selling some equity for $10 million, that would be 10 divided by 1 million, which is the revenue, with a revenue multiple of 10. Kind of what that means, or what that represents, right, is if we're a company and we're making $1 million in revenue, that would take, 10x that amount to be able to pay off investors at that valuation. So typically when you look at revenue multiples, you're also thinking about how fast is that revenue multiple changing? What's the growth rate of that? If they're doubling year over year versus growing, say, 10%, then it may be that you offer them a higher revenue multiple, because the current revenue multiple, and that's where you can get into the nuances, you can look at forward revenue multiples as well based on projections, or current. That's where it comes down. But, key takeaway here. So we're seeing a pretty big spread. I'm going to kick things over to Léa and Teddy. Taking a look at this, and given that both of you look at a lot of deals, every single week and every single month, what were some of your takeaways from the data since 2025?
Unsurprisingly, the alcohol, tobacco, food and beverage, apparel, fashion, those tend to be on the lower side of that, and that is because startups in those spaces, there's an obvious model for, if you're creating a new beverage company, okay, where do you manufacture it, produce it, and then you got to sell it direct to consumer, start getting into retail, and it's kind of very clear how you're doing, and because of that, revenue multiples tend to be lower for those companies because there's not a ton of future high growth baked into those valuations, whereas companies that, are an AI software, that's clearly better than any of the incumbents in the space, maybe they only have 300K in revenue, but if you look at widespread adoption and kind of where the entire market's going kind of towards AI first, then that company could demand a much higher valuation to revenue multiple, because there is a lot of high growth that they can, make an argument for, that's baked in, that, is baked into the valuation and could make it justified why it would be a higher multiple than some of these other kind of hardware CPG type products.
That's a very interesting chart to look at, but I think it's also a tool for investors. So if I were an investor, I'm an investor, I will come back to this chart and try to kind of use it as a reference every time I want to make an investment. I see way too many times companies online that are raising outrageous revenue multiples. Like you say, over 50x, over 100x, it just doesn't make sense anymore. And some of these companies are still raising millions and millions of dollars. And I'm afraid for these investors, because it means that it's going to be extremely complicated for them to actually make a good return on their investment. They are taking a tremendous amount of risk. So if I wanted to invest rather into a company, I will come back to this chart. I will try to look, okay, what is the industry that I'm investing in? What is the median? And I will do my best to not invest over the median, because simply except if the company really has a unique value proposition, you truly believe in what they can do, I'm afraid that you may get a return, but it may just not be worth the risk, and that will not be the best use for your money.
Yeah, you bring up a really good point. So the medians here, are that the middle line in each of these boxes. So it's kind of the first quadrant. So like 25% of all deals fall within, there. The next 25%, so all the bottom 50% are below this line. And then this is the third quadrant, so kind of from the 50th to 75th percentile. And then the top quartile is kind of that last bar. So you can read each of these that way. Now, one of the things we did do, we computed the overall median for the industries over basically the last 12 months. And I was surprised that it was about 19.5 was the median revenue multiple across all equity deals being offered online under Regulation Crowdfunding and Regulation A. Now, one of the other things we're also going to be looking at is how has that trended over time, so that we'll be able to take a look. Obviously, you may guess 2020, 2021, the time period when, a lot of money was flowing into deals. I think that we have the suspicion that the revenue multiples were much higher back then. So we'll also be presenting that in the chart of the week when we include this data. The other thing to be aware of too, though, is if you're going and looking at a median, you need to take the number of companies and data points into account. So like education, training, and coaching, there's been basically 3 companies. It's going to show you a median. It will still compute it as 8.3. But with so few data points, it's hard to really draw any conclusions. And, retail shops and department stores, for example, there's been 1 company. So just take all of that into a grain with your consideration, with a grain of salt, where obviously the more data points, kind of the better representation. And it is probably just that some of these industries aren't as utilized by some of these exemptions like Regulation Crowdfunding, Regulation A. Similar thing you could see, logistics, delivery, and supply chain, one at the high end, one at the low end. So it's going to give you a median, but you got to make sure you're actually looking at the data and not just using it without any guidance or understanding. Now, the thing that I mentioned before, too, I think it's actually interesting to take a look at are some of these outlier companies. So this is showing by size the biggest revenue multiples by company over that same time frame. So this is the same data set. So you can see Boxable here with a revenue multiple of 10,100. EnergyX, also a very successful raise. They raised on Dealmaker, but with their revenue multiple of 5,000. They had big revenues, but also a big valuation. And some other ones on different platforms, Blockframe, cybersecurity, on Mondial Financial Group. Provita has done 2 raises. They're a healthcare and pharmaceuticals company. And so you can just see as well that the colors here correspond to different industries. So some of the industries, like you can see this inner segment here with the blue, if we take a look at what industry that is, it's alcohol, tobacco, and recreational drugs. So a lot of those companies, you don't have kind of those high flyers, like super high growth, probably type companies. It's probably being valued more based on their actual revenues and like traction and that sort of thing. And you can also see, some of the pink ones in here, given there's a few outliers. with Gen AI works and also immersed, but that industry being business software and applications, so basically SaaS tools. So it's kind of interesting to look at the breakdown by industry as shown by the color, as well as some of those outliers here. But Teddy, Léa, before we move on to the next segment, any other takeaways just in terms of revenue multiples or how investors might want to use them, or even how a founder might want to think about this when they're thinking about doing a capital raise?
I kind of want to just remind people how the math of investing in startup works. Most of your deals are going to fail, and that's why it's important to target high returns for your deals when you invest, in order for it to kind of compensate the risk. If you have a very good exit, if you have a very good investment that gives you a lot of return, that can compensate for all the losses you will make. But when you invest into these companies with high multiples, so like Energiac, which has a 5,000 revenue multiple, even if it already is making 2 million in revenue, you are already compromising the opportunity to make a good return with that company. I mean, if I do 5,000 multiplied by 2 million, they're at least $1 billion company. Try to think about it. What's the chance for them to actually become a $10 billion company? It's extremely risky. Yes, it can happen, but it is very risky. And so it's very important for investors to maybe not always just follow the hype. That is, when you see millions of dollars being raised, you think this is a good deal, but think on your feet and remember that you're putting money into startups. It means that it's an opportunity cost. You could be putting your money into the stock market. You could be putting your money into an REIT and get real estate kind of work your money at a lower return, but also at a lower risk. So is it really worth it to invest into these high revenue multiple deals? I don't know.
Well, I want to bring up a good point too. So Teddy being kind of our in-house, biopharma, biotech expert, how do you think about revenue multiples? Because obviously that might be a little bit of a different beast if you're just thinking about pure revenue multiples when you're looking at a biopharma company.
Yeah, I'll just say really quickly. So EnergyX, they have a really high revenue multiple, but a lot of people, like unless you were on Kingscrowd and saw that we calculated the valuation, like their valuation was not stated on their raise page. So a lot of people just saw $2 million in revenue, like this company's great, which they are a very strong company, don't get me wrong, but they didn't show their valuation. And I actually asked them for it in their Q&A and they deleted my comment. So that is just always something to look out for. Like if you're not getting a valuation up front, then you can't calculate a revenue multiple and you don't actually know if it's fairly valued or not based on its revenue. So that's like super important to figure out before you invest in a company, because valuation is directly impacts your returns because you actually know what the hurdle rate is before you start seeing a 1x or higher. So sorry, I had to just get that off because that was just...
It's a good point. So the thing you touched on there's a quote where I forget the exact quote, but to paraphrase it, it's like the difference between a good company and a good investment can be great. So you could have a great company, but at an outrageous valuation, it just doesn't make sense because you would never get a return. Conversely, you could have a company that's, sort of like not doing too great, but if they give you such a fantastic deal that there's a potential for, the ROI and the investment, it could actually make a good investment opportunity. So being able to separate the two in your mind is something really important for investors to be able to understand. Now, all that being said, right? So there are cases where that applies. There are other times when revenue multiple maybe isn't one of the best measures to use. I'm thinking like some of these early companies like pre-FDA trials, Teddy. Maybe you want to talk about just, does that make sense to look at a revenue multiple then? Because it might look pretty crazy high if you were.
Yeah, so with early stage pharma and health tech, med tech, a lot of times you'll see companies where you read their raise page and it'll say, we are in preclinical trials, we are in phase 1 human trials. Our product, our drug is not commercialized yet. But if you look at their P&L, their profit and loss statement, like they'll have $1-2 million of revenue, and that is not actual product revenue. That is because under accounting practices, you're allowed to record, or you're supposed to record, government grants, so non-dilutive funding that you get as a revenue item. So in that case, it obviously doesn't make sense to look at revenue multiples because that's not actually revenue coming from the product. In the majority of cases, the early stage pharma and medtech companies raising on equity crowdfunding have not commercialized a product yet. So you don't even really look at the revenue multiple because they either have no revenue or the revenue they have is not actual product revenue. So in that case, it's way more looking at, total addressable market, how many people in the world suffer from this condition or whatever the product is solving. So in that case, it's much more of a, quantitative assessment when you're looking at addressable market and a number of people, but also a lot of it's qualitative. In that case, team is super important, people that have commercialized drugs or medical devices before. So it just kind of like changes the analysis. Whereas if a company is, in another space has revenue and, doesn't have this really long commercialization timeline, revenue multiple makes a bit more sense to look at.
Sometimes the valuation is even just based on the value of the patents or the value of upcoming revenues. We invested in EarthGrid, which is an energy company, when the company was valued at about $18 million, and had a revenue of about $300,000. And it was the same case as what Teddy mentioned. It was not actual revenue, it was pilots. So the revenue multiple is outrageous, but when you look at the actual value of the company, they had dozens and dozens of patents. So the 18 million was valued, and they already had a $7 billion joint venture in which they were involved. That was kind of promising that they will give, millions of revenues in the future. And that was kind of for us justifying the valuation. And even if it's still high, we made the move for that reason. So it's important to look at the whole picture.
Awesome. Well, I think that's a great point. It's just the revenue multiple is another tool in your toolbox as an investor to evaluate opportunities. It is not the be all end all, though. There are exceptions. There are reasons why it could be high. For new companies, it's often going to be outrageously huge because they have a small amount of revenue. And so you kind of discard it and you don't really consider it. But the more traction, the more revenues that a company brings in, especially if you take a look at public market comps, that's where a lot of these revenue multiple kind of standards by industry get set, where, 10x, 15x, kind of that range might be something reasonable to see in the public markets. All right, well, let's wrap things up there on the revenue multiple discussion. And next up, we're going to bring Scott Kitun, the industry insider, back into the conversation. Welcome back, Scott.
How you doing?
Pretty good, pretty good. So we want to talk about, and this is something you've brought up before, Kingscrowd, as a reminder for anyone who hasn't kind of checked it out, has this exit tracker. So we record and find all the different exits. Lots of shutdown businesses. If you look through certain years, if we go back to certain times of periods, we got mergers and acquisitions as well as IPOs. So all these data for these companies are input into our database. This automatically syncs with your Kingscrowd portfolio. I think it's a really fantastic way to help you manage just once you start getting a bigger portfolio. But I think one of the cool things that you can do with this, and that we wanted to do as part of the discussion today, is do a post-mortem analysis on one of these companies that recently shut down. So PvP is a company that recently announced that they were going to be closing. Basically, the email to investors kind of informed them that they were facing challenges with funding milestones, product market fit, and just not able to find sustainable growth. So what we wanted to do was actually go back to the Kingscrowd Raise page and break down this company, take a look at it and see, were there potential hints, flags here that we may have been able to pick out, obviously hindsight, kind of 2020, knowing that they're now shut down, but are there things with this company in particular that stood out, and be able to show and highlight some of those different things. So I will pull out, just one quick piece of data. So this is the Raise page for PvP. This is a company that was kind of a Web3 gaming community company. They kind of pivoted throughout part of the journey as well, which, we can talk about the good and bads of pivots. But if you go down to their funding history, we can also see that they did multiple rounds online. So they did their first raise on Start Engine back in 2021. They raised $3 million on Dalmore Group in 22. And then you can see they kind of petered out a little bit. They raised 88K and then 100K, despite it being a big down round in their valuation. So again, down rounds and small raises are not necessarily red flags, but this would have been the first thing in my question kind of that would pop into my head is like, okay, what happened? Did something change, from their round? And given that it was a different macroeconomic environment in 2022 that led to that though, right? And was it the way that they're presenting themselves, traction, or something else? I'm going to turn it over to the rest of the committee here. What do you guys think? Taking a look at this page, you want to pull out any other key points on this company to talk about as a postmortem?
Yes.
Go for
back
it,
down
Scott.
Go back down to where you were. All right. Bring the cursor to the far left of your screen. You'll see close date. Please put your highlighter on the top two and the bottom two, and you will see 21 and 22 takes place when we were all hanging out at our homes, wearing little masks, playing video games, and talking online. It is also when people got very creative, whether that was through edibles or their own imagination, and they started investing in cryptography and art and things that were digital in nature, as if we were never going to be together again. And I think that I interviewed this founder on my show, and he was as impressive as anybody else you'd ever talk to. There was nothing about this business that could possibly go wrong, with the exception of us leaving our homes. That was a problem. And I think that you've seen it. We literally could pull up, and maybe you can on here even in the course of this conversation, look up any game, any video game. If it's Web3, it's particularly going to take a bit of a knock just because of the nature of it. But anything that is in the video gaming space that we see on here, or you want to go into like the social media clubhouse, virtual circles is another one. If you look up any of those, I would bet you that you will find very similar, maybe not go out of business, but you will see very similar, very strong numbers, very strong valuations, and then kaput. And I think you could extend to private markets in venture that are not online. You could probably, to be honest with you, of all this public stock market companies that are in gaming, which includes the exposure that Meta had, they changed their fucking name to Meta. Like, that's how crazy this got. They all took a bath. Oculus, Apple launched their Apple Vision Pro, flop. The only gaming company, to my knowledge, that's on the up is Epic, because they're winning a lawsuit with Apple in the App Store. Has nothing to do with the gaming part of it. Is Take-Two, and that is because they're mobile gaming, and they obviously also have, hopefully we'll see what happens with Grand Theft Auto, but like they have a handful of like marquee things that go predate COVID. And I think that right there alone, like, I'm sure that they're not a perfect company. I'm sure there's all kinds of other little factors, the runway we could talk about, all this stuff. The beginning, middle, and end as to why PFP, like many other in the space, took a bath is because they launched where everyone only knew them basically from COVID. And then once we left COVID, we're like, we're back to touching grass. And all of a sudden making money like that just became really difficult. And a lot of the assumptions that these companies made never came to fruition. And that you could go post-mortem on probably dozens of types of companies that this happened to as well. But video gaming in particular, we've been hearing for 20 years, is the next thing. We're all going to be on VR and headsets and playing games in a fucking metaverse. That's what's happening. And then the metaverse became outside, and then that happened. And rant.
I'm curious, Scott, with your own investing, looking back in history, it's more apparent to see, right? Like, okay, yep, obviously video games, or you could think about crypto bubbles or NFTs or VR, like you said. What, if anything, is that today? Like, what frameworks do you kind of use to say before you're investing, like, is this something that's just like the hype of this year? This is what's being hyped up, or like, is this actually like a long-term sustainable trend?
So first off, I will say this to anyone who's investing. You really have to like look at the space and like take yourself out of it, unless you work in it. Take yourself out of like how cool this could be or whatever. And like, just do some research and you'll find out that this is like I'm not exaggerating. It's about a 20-year, pretty much post.com era of video games are the future, gaming is the future. And of course it is, it's big. I mean, Ustream turned into what it turned into, and Amazon's in that space and Microsoft's in that space. And so I'm not disputing that gaming is huge. Of course it is. But this idea that everyone, grandma to child, are going to be playing online in their digital avatar self, like, maybe that will happen eventually. I think that'll be a pretty bad world to live in, but whatever. Like, take yourself out of the macro and look at the gaming space in particular. And you could do the same thing for any other space. Like, all investors, whether you're super experienced or not, really need to like look at the historical track record of a market before you jump in, which is why Kingscrowd's so great, because you literally can back out 7,000 square feet or whatever. Why did I say square feet? 7,000 feet, whatever, and look straight down on it. When I look at my own investments, I'm like, I don't think it took a genius to see what was super COVID-y and what wasn't. So like, I don't take any credit whatsoever for like recognizing a few deals that I avoided. I mean, I arguably had a company that like fell for the COVID thing in Songfinch and similarly Cameo, but I would argue that those companies predated COVID and postdated COVID, and they just had the like apex mountain during COVID. So like, I don't think that totally counts. Generally, when I'm looking at macro, micro for any sort of a company, you literally, and this isn't for everyone, this is like some people are like Andreessen and others are just really, really good at this, and they win again and again more often, and not just proximity and money. They can envision a world that it will inevitably have something. Like my wife continues to talk about our girls driving cars and they're flighty, and the idea of them driving a car makes me insane. But I keep saying that they're not going to, because I think it is just super inevitable that we're going to have Waymos everywhere, and it's just not going to be a thing. And like, this is one of those things where it's like the leap of faith you have to make to assume that people literally have no interest in engaging IRL as it became known. Like it's when you take out the hardcore gamer type and then the age group, and like those of you who are 40 like me now and up, your hand-eye coordination, your like speed, quickness things, like all that kind of cognitive stuff declines. Playing video games like Call of Duty is not as fun for anymore because I'm getting the shit kicked out of me when I used to be the guy who did the shit kicking. And like, it just, when you do that whole market analysis, you realize that it's, in order for them to hit the numbers that are in this deck that they published, they raised during 22. I don't know if you can still click on it, but on 22, they have a deck, as I looked at it as a deal, that goes through a very large user base that now in retrospect, if you just use common sense, you would recognize is like pretty asinine.
Now, Teddy and Léa, I know you also look at a lot of deals, so there's kind of the trend and like broader company getting into, is this something that's just being hyped up? Are there any other things that popped out? If you were just taking a look at this page, let's assume we didn't even have the history over the 4 funding rounds. If we were just looking at one of these rounds in its own isolation, what are some of the things that might have at least raised questions, or, that you might have pulled out as an investment analyst looking at one of these opportunities?
The first thing that I saw personally, so when you just look at the blog, the description, you open it, you can read, this is this gamer social community, gaming hub. What does that mean? That's a platform that, in order to be attractive, has to always be bringing new users, always has to be growing. And just by definition, this type of business is extremely risky. I know that there are some successful ones, the Reddit, the Twitch, the Steam, and as you can see, I'm pretty limited on the video game platform vocabulary. But these couple companies that are big are really concentrating most users and the Discord, like Teddy just said. And it's just very complicated for smaller businesses to make it. It's not impossible, but it will require time and a lot of capital. PvP was not starting pretty badly because it already had 2 VC investors by the time it raised. So sometimes having VC interest is kind of key for these companies to be able to grow. But just if they did not follow, if nobody else was willing to put tens of millions of dollars into these platforms, it just meant to fail, except if for whatever surprising reason, it just manages to really be extremely interesting and attracting for users. But except for that one exception, it's just a very, very risky business to invest in the first place.
Totally agreed, Léa. And also, side note, I think one of the VC investors was the VC fund of the founder. So, but anyway, when I was looking at PvP's page, I think the biggest thing that stuck out to me was, they have, 150,000 users. They have, they're essentially still pre-revenue. And if you go to like financial traction somewhere on the page, it says, it's basically like, we have strong financial traction and we are projecting $2 million of revenue. And, we've raised X amount of dollars. So they had those projections, but they haven't shown proof that they could actually monetize their user base in any meaningful way. And if you go to kind of the financial I think financial model. It's like very unclear kind of how they make money, and they haven't kind of proven that they could monetize their user base, so they couldn't just like point to one thing and say, this is where our revenue is coming from. And I think it was just a very difficult type of space to be in, again, with the kind of incumbent players like Discord and the other ones Léa said, just kind of dominating. So I think PvP tried to differentiate with this whole NFT token marketplace situation, where it was just, as we know, like that whole industry kind of just went downhill very quickly. And yeah, I think it was just a super tough space to be in, both on the gaming side and trying to like do the Web3 angle as the differentiation. Which,
Brian, stay on that slide for a second. We'll keep digging this hole deeper. Picking up from where Teddy left off. Any media business, when you scroll into the financial model and it doesn't say what the financial model is, it's an advertising model. Like whether it's advertising directly paid by outside sources or them using clicks to drive traffic to sell NFTs, games, et cetera, the margin on a game, and this took place before the Epic Apple App Store kind of lawsuit decision that's just currently going through right now. The margins are like razor thin. They're not in the game development space, so they're a reseller, which means unless they have massive volume, no one's going to give them any sort of like massive discount. They have no defensibility whatsoever. So then I have to look and go, okay, you're an ad model that doesn't want to say you're an ad model. How many users? You say, oh my God, we have 167,000 blah, blah, blah users. And I'm like, Kingscrowd's got like 70,000 newsletter people. Like we have a better, closer chance of making $2 million next year on this show than they have on making it on that platform. And that's just simple math and not even trying to be, an asshole about it. Like it's just, there's a lot of these companies, and it's not just in crowdfunding, it's across the board, because so few people understand media and like how money does and doesn't travel through it. And I think one of the points that both Léa and Teddy hit on here, and I just want to like slam it home, when you talk about Reddit and Discord and the rest, they weren't built, like Twitch is built for this because it bought Ustream. And Ustream was built on this because there was basically nothing but horrible comms for online gamers. It wasn't because like they were like, oh, it's going to be a thing, people watching others play games. It became that. But it started off of like everyone wanted to copy Call of Duty where you could like talk, but you couldn't hear shit because if the internet was bad, everything was laggy. So they just created this like talk space. And if you look at this and probably every other kind of company similar, I saw another one recently that does this, but for music and games, they're probably going to end very similarly poorly, because Reddit was built around something else and evolved into a gaming centric area. Discord started as a communication app and the Signal app and becomes sort of the Web3 mouthpiece because weirdos wanted to stay anonymous. Like this is just another example of like, if you try to build something that just takes a nice to have or an experience that people are generally pretty happy with, like last thing I'll throw in here, like you're going to see a lot of these coming up. The book reader, AI generated summary, book, podcast, summarator, whatever, like horrible investment. If you're looking, all of you, like if you, any of you looking at like Goodreads is not the greatest thing ever. Audio book on Spotify and Apple Books is like not the greatest experience ever, but it is close enough. It provides a good enough experience that whoever comes in with some AI wrapper around it, it's like you could make, a book club better. Like it's just not going to win, because the vast majority of users, the 80%, 70% of users, similar to gamers, like have their clan, so to speak. They have their girls that they talk about their books with. They have their, bros that they pass inspo with. Like you have to like reinvent how we consume video games, like reinvent the platform. And that's the only way that they were going to have success. And I think you're going to start to see actually a lot of these shake out over the next couple of years, because everyone's going to come in with this kind of the new way to do X, and it's not new. It's just,
So are you like going back to what you were saying about trends, Scott? Do you see any of these trends in macro themes today? Like AI, for example, is it AI wrappers of X? Is that something?
Yeah, it's everywhere. Like, I mean, I honestly don't even know where to stop. Like it comes down to, good data is matterful only as long as that data being unique is special to you. So like if you're Kingscrowd and you're an investor on Kingscrowd and you specifically want data around online only in this sector, like then it probably is important for us and you that this data is a certain way. But like generally, I think the one that's making the new rounds is what is it called? GenSpark. I think GenSpark.ai is the new big hot thing. They've done like 45 million MRR in like less than 9 months or some stupid number. And all it does is it's multimodal. It takes into account and takes responses from every single of the main, the ChatGPTs, Geminis, Claude, Grok, takes them all and kind of runs them together, kind of like Perplexity. But then it builds out its own things for like creating videos, creating images, creating decks, creating spreadsheets. Like our friend Pompliano just grifted a new CFO tool called Sylvia that somebody else grifted, somebody else invented, that he put his name on, and he's already got claiming $2 billion in like money that's being run through it. Probably true, good for him, great platform. But all it is a wrapper that like anyone could build on Replit. So you were just going to see this like ridiculous push of people building AI specific, targeted, solve this one problem. But the reality is like, it's like, you know, general practice doctor. Like they pretty much everyone could just go there, and it's only when you need a specialist that it matters. So like, I just think the number of AI companies that are going to make it easier for a financial analyst to read stuff, that are going to make it easier to do lead gen. You literally could go on ChatGPT right now and do lead gen and probably do 80% plus of the quality as if you paid for Clay and others. And like, so yeah, Clay exists for a reason, right? Because they can get you the last mile. But like for the average person, that doesn't matter. And so like a lot of these groups are going to have, you know, 2 million to 20 million in MRR or ARR, obviously a huge difference, but like that kind of volume, and it's going to hit a wall and going to disappear. And it'll just sort of be this like, yeah, we were like a $50 million business, and then we were like a $2 million business, and we're kind of still a $2 million business. And I think this is the one area that in particular retail investors have to keep their eye out for. Like, it's actually okay to be late. Like, let this shit roll out. It doesn't matter if you get into the 10 million round or truly the 100 million round in this case, because it doesn't, they're not going to, I don't think you're going to see a huge win for a lot of them.
Well, it kind of goes back to what we were talking about with revenue multiples, but I think one of the things I took away from what you're saying, right, is especially with all of these quote AI wrappers, early days, you could probably get a small audience very fast. Yep. What investors shouldn't do is take that very fast growth and extrapolate it and say that's going to continue to $1 billion company, right?
We're all still looking at this like SaaS. It's like hard to wash the SaaS off.
Yeah.
You're like, oh man, this is when Rippling did this, and this is when HubSpot did this, and you know, Loom and Zoom and everybody else. But like, we're really in this era where people are really curious. The price point you have to remember is never been lower for a tool of this kind of power. To be charging $9.99 or $20 a month for a product that can do like 80% of your daily workload is like unheard of. So for me to sign up for 5 or 6 different AI tools at once, $20 a month committed, just to see which ones I like and fuck around with them and then delete them, is like nothing. That's like not a risk at all. And so you're seeing all these companies who are basically raising rounds saying we waitlisted and it was stealth mode, and now we have 1,000 users, and now it's 100,000 people. It'll be 20,000 people in about a month. Like, it'll just go back, because we are all finding out that LLMs themselves, like, it's just sort of all commoditized. And the only difference that's going to really win the day, and I don't know, and there's plenty of versions that probably do this already, but like for my money, the winner of the day is the one who can most easily help me take my use case context and data and actualize it personally and apply it to what I'm trying to solve for. That's all. That shit takes place between me and ChatGPT, not ChatGPT and the data center. It's between me and them. So that latency level, whoever solves that's going to win, and anything in between is just recycling the same shit and putting a different sticker on it.
Scott, you're always good for the hot takes, and appreciate you joining us today. So I know we're coming up on time here. I think we'll wrap it up there, but this is obviously going to be continuing ongoing discussion just in terms of different trends and stuff. We'll make sure we bring up some of these topics as they're relevant. And for anyone who's out there who is listening, if you aren't already a part of the Kingscrowd newsletter, head over to newsletter.kingscrowd.com. We have a free newsletter. You get a bunch of these amazing insights, some of the staff picks from Léa and Teddy each week, and we dive into a lot of this data and the charts. So we will hopefully see everyone back here next time. Until then, thanks and see you then.